Welcome everyone. My name is Ian Dembinski from Rathbones, and it's my pleasure to be hosting today's 30-minute first quarter investment insights program. I'm joined by two of our senior wise owls, and they are Ed Smith, who is co-CIO of Rathbones, and Sanjiv Tumkur, who is head of equities. Now, the purpose of these sessions is to cover our market views rather than discuss individual clients' portfolio performance. And if you have any questions in that regard, please do take this up with your Rathbones investment manager. If you're not a client, then a very warm welcome to you as well, and we hope that you will find this session useful. Now, I'll be asking Ed to recap on what happened in markets in 2023. I'll be inviting him to take a fresh look at the outlook for inflation and spell out what our investment strategy is for 2024. I'll then turn to Sanjiv and invite him to comment on the so-called Magnificent Seven stocks which dominated market performance last year, and whether we can expect the market to be driven by a broader number of stocks this year. So before we begin, please do write in your questions in the chat function, and I will pick these up as we go along. We're also very interested in your views on whether you like this format and approach. So please do also write some feedback so that we can continue to improve how we communicate with our community. You can also pre-register for the next webinar on the engagement panel on the left-hand side of your screen. So with no further ado, we'll turn to Ed first.
Thanks very much, Ian. So developed market equities had a very good year last year. The US market rose by 24%. What drove 2023's returns? Well, broadly, there are three things that influence stock prices. And as this chart shows, these are changes in profits, changes in the interest rate you use to discount future profits into today's valuations, and changes in how certain you are around those future profits. Now, last year, while the S&P 500 US market index gained 24%, the underlying company's profits didn't rise at all. And 2024's profits are expected to be 3.5 percentage points less than what investors expected this time last year. So profits didn't influence the return. Meanwhile, the 10-year US Treasury yield ended the year almost exactly where it started. This bond yield is the world's risk-free rate in the jargon. It's the benchmark for discounting tomorrow's profits. Therefore, the huge 24% gain of 2023 was driven pretty much entirely by that third factor: increased certainty in the arrival of future earnings, a reduction in the perception of the risks. In technical terms, we call this a fall in the equity risk premium, the rate at which investors are willing to accept the risk around future profits, over and above that risk-free rate. This equity risk premium is now at a low not seen since 2007. So in other words, investors in US stocks are more certain about the next few years of company profits than at any time since before the global financial crisis. Now, what I want to ask today is, can we really be that certain? There's also the fact that last year's returns were among the narrowest on record, and by narrow we mean that just a few very large stocks beat the index while most companies lagged. Sanjiv is going to talk to us about the so-called Magnificent Seven shortly. Now, inflation was the top concern, I'd say, this time last year. And as this chart shows, investors were certainly right to cheer a huge reduction in inflation uncertainty as we progress through 2023. Averaging 38 advanced economies shows that it took 14 months for a standardized measure of inflation to peak after it broke above the historic norm in 2021. Now, as you can see on the chart, it's taken 13 months for it to fall within spitting distance of that same threshold. So is that job done? Well, here we have core inflation now. This strips out energy and food prices, and it's on track to do the same, but it has still got quite some way to go. The final few miles on the inflation journey may be tough, but there is good evidence that there is more disinflationary pressure in the pipeline, not least because there is no longer excess money creation from central and commercial banks. Now, 6-month and 3-monthly rates of core inflation are well below the usual annual rate. So in other words, disinflationary momentum has built more rapidly in the second half of last year. But while disinflationary momentum continued to build in Europe over the final few months, in fact, the Eurozone is deflating on the 3-monthly rate of change in inflation, falling prices, not just the falling rate of inflation. But things are in danger of getting a little stuck in the US. The 3-month rate of change has been rising since the autumn and is above the 6-month rate of change. Now, some of our audience also may be wondering about the disruption to shipping routes in the Red Sea, and could that pose an inflationary risk? Because last time shipping costs spiked, inflation let rip. But that doesn't mean there's causation, right? So at the moment, we are fairly sanguine. Container prices rose almost 700% during the pandemic. They've doubled recently, which is orders of magnitude less. And they only rose 5% last week, so there's a bit of stabilization. Unlike last time, shipping costs on all routes aren't spiking at once. Unlike last time, inventories of manufactured goods aren't really unusually low. And unlike last time, shipping costs aren't joining a perfect storm of supply and demand shocks to unleash a huge wave of inflation. All that said, if the last few years have taught us anything, it's that we must be pretty humble about our ability to truly understand the inflation forming process. And so long as we're not quite at the finish line, we have to acknowledge that there is still some upside risk, some uncertainty, and investors need to assess if they are being adequately compensated for that. We think we are in the UK and the Eurozone, but we may see another bout of volatility driven by concerns around inflation and consequently interest rates in the US, possibly before we can breathe a final sigh of relief. So what does that mean for interest rates? The market expects 5 or so quarter-point rate cuts in 2024 in the US and the UK. If we have a recession, it's likely to be much more. If we don't, it is theoretically possible, but practically unlikely, given that policymakers have lost confidence in their own ability to understand where the so-called equilibrium rate of interest truly sits, which means cross-asset pricing is possibly paradoxical. Is the environment that permits greater than 10% profit growth, which is what the consensus in equity markets expects, the same environment that permits 5 rate cuts in 2024? Not until inflation is assuredly back in the box, in our opinion. So there are some risks, there are some uncertainties. Investors advocating the Goldilocks view are advocating for something that could be summed up by the phrase, "It's different this time." Now, for sure, look, we only have 11 US business cycles to analyse since the Second World War, and even if we build on that by building a panel of other regions' business cycles, our data set isn't that much richer because all these business cycles are interconnected in Western countries. So statistically, therefore, we can acknowledge that it could be different this time, and that's why our investment committees proceed probabilistically, considering a range of scenarios. But the scenario to which we assign the highest probability is a mild recession, because the aggressive rise in interest rates, together with tighter commercial bank lending conditions, and a contracting supply of real money and falling real sales and profit growth and rising unemployment have almost invariably signaled a recession in the past. For example, so-called soft landings, avoiding a recession, have only occurred 3 times, and only when commercial banks have been making it easier for people and firms to borrow, not harder, which is not where we are today. And when all of these things are flashing amber or red at the same time, it is bold to say definitively that they can be ignored. Of course, much like the effects of monetary policy, the lags between all of these signals, all these warning signals, and the start of a downturn are long and variable. US recessions have tended to arrive in the 3rd year after the first Federal Reserve rate hike. That covers 2024. Now, we were wrong to assume a recession would start last year. Excess money continued to be spent. We kicked the tires hard on this, and our analysis suggests there is still one ahead. We issued our mea culpa last year, but we really looked hard at this, and we still think there's one ahead. So to sum up, look, there was lots to cheer last year. Inflation uncertainty reduced significantly, but there are still risks around future profits, around the last mile of inflation, around interest rates, which means we want to stay invested, but with a defensive mindset. I'm going to hand over to Sanjiv now to talk to us more about the Magnificent Seven.
Thank you very much, Ed. Hello, everyone. So the Magnificent Seven is the name that's been given to the world's 7 largest technology companies. These are Microsoft, Apple, Alphabet, Amazon, Nvidia, Meta, and Tesla. As this chart shows, they all saw strong performance last year, driving 60% of the 24% increase that we saw in the Standard & Poor's 500, the S&P 500, which is the main US stock index. If you exclude these Magnificent Seven companies, the remaining 493 of the S&P 500 companies only grew 9%, and the chart you're seeing shows the divergence in performance. These 7 companies now represent a whopping 28% of the entire S&P 500 index. Why did they buck the trend of a more pedestrian general market? Well, from our perspective, there were 3 main drivers for these companies. Firstly, their strong performance in 2023 can be seen as recovering underperformance that they saw in 2022. This next chart shows the performance versus the wider US market in recent years. So they'd risen strongly before and during the COVID pandemic, as technology was a key gainer from the changed behaviours that we saw through that period, whether through the pull forward of demand for laptops and smartphones to facilitate working from home, or higher demand for online retail as physical shopping became much harder. This led to investors extrapolating the higher growth rate as being the new normal, raising their long-term growth assumptions and raising the valuations they're prepared to pay for these companies in 2020 and 2021. Also, interest rates were slashed to virtually zero in order to stimulate economic activity during COVID, and these ultra-low interest rates were then used to discount future profit expectations for growth companies back to the present day more generously, giving them an inflated fair value. Interest rates rebounded rapidly in 2022 as inflation became an increasing problem. And this led to those higher valuations for growth companies being slashed and their share prices falling, particularly the Magnificent Seven. 2023 saw valuations recover much of these falls as evidence built that inflation was being brought under control and as the possibility of interest rate cuts in 2024 grew. Now, the second driver of the Magnificent Seven was the remarkable advances made in artificial intelligence, specifically generative AI, which was spearheaded by OpenAI's ChatGPT and also Alphabet's Bard. Generative AI has significant potential to transform business models and create new revenue streams for companies both within and beyond the technology sector, while making other business models obsolete. Generative AI captured the imagination of the public and of investors in 2023 and led to significant share price appreciation for the Magnificent Seven, particularly Nvidia, which saw growing demand for its graphics processing chips from customers who were keen to train the large language models required for generative AI. Companies developing those large language models, such as Microsoft, Alphabet, and Meta, were also pushed higher, as was Amazon, given that its large Amazon Web Services cloud business was seen as an AI beneficiary, and Tesla, as its heavy investment in self-driving technology was perceived as making it a major AI play. Now, the third driver of the Magnificent Seven was scarcity of growth, as the more challenging economic conditions that we saw in 2023, brought on by higher interest rates and geopolitical tensions, meant that profit growth was much harder to come by. Many companies have been achieving sales growth purely by raising prices to recover cost inflation, often seeing volumes contract as a result, and genuine growth has become scarce. The technology sector, with its revenue growth driven by innovation, stood out as a beacon of volume growth and of rising share of GDP, as technology becomes ever more entrenched and prevalent across the economy through the spread of cloud services, AI, and the Internet of Things. Investors were prepared to pay up in order to access this superior and scarce growth. But how unique are the Magnificent Seven? Are they in a league of their own? How likely are they to continue to dominate performance in 2024 and beyond? Well, large technology companies do have significant advantages. They have big economies of scale. In the case of companies such as Meta and Alphabet, they have more than 1 billion users, an entrenched advantage which makes it much harder for newer competitors to win against them. They also have prodigious cash flows and generally cash-rich balance sheets, which they can then deploy in cutting-edge innovations such as AI, or in buying up new rival startups so that they can choke off serious competition almost as soon as it develops. Now, as this chart shows, the wider technology sector has actually outperformed the market in recent years. It's important to note that 2023 was not purely the domain of the Magnificent Seven. A broad range of technology stocks performed extremely well because of the three issues that I spoke about earlier, but in particular because of recovering lost ground and offering scarce growth. This chart shows the performance relative to the wider market, as I've said, and you can see that from 2015, technology has only underperformed the wider market in 1 year, which was 2022. Many other software companies performed well last year. For example, Adobe, Intuit, Oracle, Booking.com and Sage. IT hardware companies fared less well, but that was mainly because they were subject to a cyclical downturn due to a period of destocking. The Magnificent Seven are often talked about as a homogeneous group, with the assumption that they have similar business models and growth drivers, whereas in fact they're all very different. For example, Microsoft is fairly defensive, with recurring revenues coming from its Office and cloud services businesses, along with significant growth drivers from AI and gaming. Now, by contrast, Tesla is much more speculative, a relative newcomer in the notoriously difficult automobile market, where most competitors struggle to make a decent return, and a market which is highly cyclical. Tesla's valuation requires a fair degree of belief that it will make a success of self-driving technology and achieve significant scale, and clearly it has a large fan base behind its mercurial CEO, Elon Musk. So I would expect the performance of the Magnificent Seven to start to diverge as the differences in their business models, growth drivers and specific markets are felt. The performance of technology more generally will be a function of what happens to the wider economy and the stock market, the relative scarcity of growth, and what happens to interest rate expectations feeding into valuations. Having entered 2024 at a relative high with lofty expectations, it will be much more difficult to match the performance that we saw in 2023. Though over the longer term, the higher growth rate seen in technology should drive decent performance.
Sanjiv, thank you very much. We've got some great questions coming in. Two have just come in, Sanjiv, around the speculation recently in the press about, quote, the parlous state of the London Stock Exchange. Do you have a view on this? And another question, how worried should we be about companies choosing to list on other stock exchanges instead of London and considering delisting from London? What's your view on the FTSE?
So clearly the FTSE doesn't have a lot of exposure to sectors like the technology sector. It does have more of an exposure to what we used to call the old economy. But having said that, we've got some great companies in the UK, and I think the baby's slightly been thrown out with the bathwater here in terms of people just looking purely for growth. The UK tends to be more of a defensive market. It makes 75-80% of its revenues from outside the UK, so it's not linked to the UK domestic economy so much. And we also see significant undervaluation of the UK market versus other stock markets. If you look at stocks in similar sectors, for example, UK healthcare stocks trading at a discount to US healthcare stocks, or consumer staples stocks trading at a discount to US consumer staples stocks. So we see there's significant scope for UK companies to re-rate. We saw a big derating following the Brexit referendum, but now we're seeing better relationship between the UK and Europe. We may start to see that discount narrow.
Of course, also, if you believe that UK companies are going to delist and relist elsewhere, then actually better to buy them in the cheaper market and benefit from the valuation uplift they get from moving to New York.
Absolutely, and we've seen that from a few companies which have moved their premium listing to the US but retain their UK listing. That has seen a benefit in terms of their valuation for existing shareholders.
Very interesting. Ed, there's quite a bit of traffic on my laptop around geopolitical risk, and in particular questions around Grant Shapps says Russia continues its illegal campaign in Ukraine, China pressing on Taiwan, the involvement in Iran in the Middle East, North Korea fueling the war in Ukraine. Couldn't geopolitics actually be the biggest driver of returns as opposed to the macroeconomic situation?
Quite possibly, and we've done a lot of work over the last couple of years making sure that we have a lot of plans put in place that we can draw upon quickly when certain large geopolitical tail risks, if they come to fruition. We did a webinar on this in the end of last year. Thinking about this year, it's important to separate sort of what are the long-term geopolitical risks that might sort of raise a risk premium over the next 10 years, what are the short-term risks that could derail markets over the next year. The things like you mentioned Taiwan, we had elections at the weekend. The Separatist Party got an unprecedented third term, but it's effectively a hung parliament. Their popularity has greatly reduced, and in their version of Parliament, they actually had fewer seats than some of the other parties. So there isn't a short-term risk. We don't think of China invading Taiwan, but their intentions are clear. You might have seen what she said as results of the elections. It is a long-term risk. We've got to factor that into how we price perhaps companies that are based there, and so on, and that is one of our large tail risks. For this year, I think the big one is what's going on in the Middle East. Will a war broaden out more flagrantly, involve more actors, Iran and US? Because if that engenders another huge inflation shock via the oil price, then perhaps general inflation expectations are being destabilized enough over the last few years that you actually get an even greater spike than we saw before. Again, this isn't our base case, but that is a tail risk, and again, something that we hopefully reassure our investors that we have planned for.
And another question's come in on the bond market. We saw yields being pretty high last year and investors taking advantage of that. Can you see yields continuing to persist higher, or will we see a rally in yields coming down?
So bond yields have already fallen a long way from their peak in the second half of last year, and we tried to get in front of that. We saw that a big change in the inflation risks happened around the start of the final quarter of last year, and we've become more optimistic on bonds, particularly UK and European government bonds. In the US, as my presentation started to discuss, there is a risk that there might be a few more bumps in the road, and that could engender some volatility in bond markets, which could feed through into other financial assets as well. But if you take a year's view, an 18-month view, we do expect, even in the US, bond yields to continue to trend down.
And can you summarize for us what you think the key investment lessons of 2023 were for our clients?
Yeah, I think that's a really important question. Always important to reflect back on what you got right, what you got wrong, what you can learn from the previous year. We do that as part of our committee processes. The big lesson for me, for any investor, I think, is the importance of staying invested. We had a lot of clients, a lot of advisors call us up in the middle of last year and say, should I sell all of my financial assets and cash out, lock in 5 or 6% interest rates, because is that the best I can sort of hope for, or good enough? And of course, we saw what happened in equity markets last year. Yeah. So you'd have missed out on a lot of return. Now, we think it's very important that if you are financially able to take risk with your investment portfolios, that you do remain invested and that you do take that risk. That's why we have our strategic asset allocations, which anchor our portfolios for our clients. And we've also back tested over the last 60 years, what would have happened if you had cashed out at the sort of local peaks in interest rates in the interest rate cycles over the last 60 years. Very often it resulted in you losing money, particularly once you get to a sort of 3 or 5 year view, which if you'd locked up your cash, you might have suffered from. So both the data, the historic data, the empirical evidence also suggests that the importance of staying invested is paramount. We tactically tilt around the very major turning points of the business cycle because that is when returns become more dispersed and the opportunities for active managers are there, which is why we are defensively positioned but anchored to our strategic asset allocation to make sure our clients who can take risk over the long term are benefiting. The future is always unknowable, so it's important to remain invested.
And where should we be concentrating our strategy in 2024?
So as I said, we do have some defensive tilts. We think quality companies within equity markets as well is very important. There was a bit of a dash for trash at the end of last year. Some slightly rubbish companies outperformed, but we don't think that's likely to continue. As the profit environment becomes challenged, as economic growth remains weak or perhaps a mild recession, quality companies tend to outperform, the ones who have a track record of delivering decent sector-beating return on invested capital or aren't taking a lot of risk with their balance sheets. We also like companies that are perhaps a little, investments that are a bit desynchronized from what's going on sort of in markets in general. So Japan is an area that we like that's benefiting from ongoing reforms. You had 8.5 trillion yen worth of share buybacks last year. We think those sorts of trends benefiting shareholders are going to continue. And then we're thinking long and hard, as we always do, about what are the companies that are aligned to the themes of a changing world, because those long-term structural, technological, perhaps driven themes, perhaps just provide a bit of ballast against the sort of ebb and flow of the business cycle. And you can find reports on our website on cloud computing, greening the construction industry, and of course generative AI.
Great. Time for just one final question, Sanjiv. People are asking about the impact of the UK election on the markets, or is the FTSE really largely agnostic to what happens in the UK election?
I think it does tend to be reasonably agnostic, unless there's a really big divergence between the two manifestos. Obviously, we haven't seen the firm manifestos yet, but I think if you look at the positioning of the two main parties, they're not wildly different in terms of the basics of running the economy. Certainly people like Rachel Reeves have gone out their way to try and woo the city, which wasn't necessarily the case with the election in 2019. I think it will have limited impact on the UK economy. And just going back to the UK market, going back to what I was saying, 75 to 80% of the FTSE 100's revenues are from outside the UK in any case. So it's kind of, I guess the currency might be sort of part of an impact of that. If we see a very strong sterling, for example, that's not so great for those overseas earners. But absent that, I don't think it should have too much of an impact.
And I know predicting foreign exchange is very difficult, and looking at sterling, perhaps the two of you perhaps together, what do you think the outlook is for the major combination of the US dollar and sterling? I don't know, Ed, if you'd like to.
Quickly. Over the long term, we think the pound is undervalued. Even if you factor in a pretty pessimistic outlook for the UK economy, a variety of long-term currency valuation models suggest that the pound is undervalued. In the short term, though, we don't believe that anyone can predict currencies well enough for you want to base short-term investment decisions on short-term currency forecasts. The academic literature is also full of papers that say nobody can do that, but there is good evidence over the long term. So we do think the pound will appreciate versus the dollar more than any other currency.
Thank you very much. It's such a shame because we've got some great questions coming in. We never seem to have enough time, but do type them into the site if you'd like us to come back to you afterwards. And that's pretty much all that we have time for today. I'd like to thank our speakers, Ed and Sanjiv, for your great insights. And please do remember to register for the next Insights webinar on the 16th of April. as well as leaving your feedback on this platform. Goodbye and have a great day. Thank you.